Good afternoon, traders and investors. Will back here with another one, coming to you with a Tuesday market recap. Hope everybody had a very beautiful day. And in today's markets, guys, unfortunately, the market correction continues. We were saying on Saturday that this may be one of the most volatile weeks of the entire summer, and so far it is not disappointing. There's a lot of apprehension coming into this week, guys, because of big tech earnings and because of the criticism of whether or not their AI spending over the last year is actually translating into revenues, or whether or not growth is actually faltering. And so far, guys, in terms of volatility for big tech earnings, it is not disappointing. Microsoft was down at a certain point over 7% in the after hours today after reporting very nice numbers, but unfortunately, where it mattered the most, where Wall Street pays the most attention, their cloud and AI segment has come in with a bit of underperformance, reiterating some of the concerns that were heard over Google's earnings call just last week. So in today's video, guys, I have a lot of things prepared for you. Number one, we're obviously going to cover a ton of earnings. Today, we're going to cover AMD, Microsoft, Starbucks, and PayPal. We're going to do more short form on those, but I do want to cover those as they were the largest ones of today. Obviously, SoFi as well. SoFi will probably do this on the Friday session. Now, keep in mind, the rest of the week is also charged with earnings. Meta, ARM, and Qualcomm and Lam Research tomorrow with MasterCard should provide us some very good indications. MasterCard for the consumer, and then ARM and Qualcomm and Lam for semiconductors, and Meta for the advertising business, of course. And then on Thursday, another big day, guys, Amazon and Apple. So most of your big tech names will officially be reporting this week, and we will get to see whether or not the concerns are only related to Microsoft and Google, or whether or not all of your major tech names are facing the same challenges. After we cover these earnings, guys, we're going to go through our major technical analysis rundown of our major market indexes, and then dive into our big tech names and see, with continued sell-off pressure, is it a good idea to be buying the dip right now, or should we potentially be waiting for a bit more sell-off pressure? Now, at the end of that, guys, we're going to take a very brief look into my portfolio for a few trades that I made today. So a lot to cover in today's video. Let's get right into it. So in today's market performance, guys, SPY down about 0.5%, QQQ leading to the downside by about 1.37. But in all reality, guys, there was a lot more names that were green than red. Take a look, guys, 340 names were green on the S&P, only 161 down, but we are still down across the board, and that is just due to the sheer weight that big tech comprises in the entire index right now, right? Google and Apple with flat days, semiconductors getting absolutely destroyed on no news whatsoever, just maybe in anticipation of some earnings that we had from AMD. AMD reporting earnings, and they actually did quite well, but definitely not a good day on semiconductors. Meta coming down, a lot of other software services coming down as well. Tesla down about 4%, but look at the rest of the market, guys. This is what I mean when I say it is a tech to value oriented rotation. We cannot deny that it has been happening. If you haven't seen my video that I put out on Saturday describing about 25 different trade ideas for this value rotation, definitely check it out. But this rotation, in my opinion, will definitely continue leading into the first interest rate cut in the month of September. Keep in mind, in tomorrow's session, we also have Jerome Powell speaking, so that will definitely add to the volatility of the week. We will get to hear his policy stances on the economy, the jobs market, and the trajectory of inflation, of course. So this has pretty much been the instance over the last day of trading, but even in the last week of trading, guys, can you see the parallels, right? Last week of trading, most of your big tech names are down, the rest of the market is up. And now even on a 1 month relative performance, guys, same issue, except for Apple and Tesla. Most of your big tech and semiconductors, the outperformers of the past year and a half, they have all been down, and now the rest of the market has been largely making up for it, right? So why has this rotation been happening, and why are we having such aggressive sell-offs? Well, we covered it, guys, very briefly in the last video that we derived last week, right? So I have a few reasons here for you guys. Not too sure why I left number 2 blank. Number 2 blank should just be tech was a safe haven for cash. Now, the sell-off reasons, guys. Number 1, AI narrative is not translating into revenues fast enough for the people who spent the most money on it. That was described in Google's earnings last week, and Microsoft just pretty much said the same thing today. They are not yet deriving the adequate revenues from their capital expenditures, and this is a concern for Wall Street, especially after the AI narrative has been so hot for the last year and a half. Number 2, tech was a safe haven for cash. Now, in an environment where interest rates are very high, guys, of course, you want to go with the companies that have the most cash in the markets to weather the storm, right? Not companies with a lot of debt, because financing costs are high. So tech was indeed that safe haven. But now that we have a very high probability of rates coming down in September, the rest of the market, everything else that's gotten crushed by high interest rates, now is finally getting a little bit of that money. to rotate into them. Number 3, of course, election uncertainty, rotation of tech into value defensive for that same exact reason. Traders are being a lot more defensive with their bets right now rather than going for the hot AI narrative with overvalued conditions. Number 4, we also have a little bit of seasonality, guys. Keep in mind that the month of August and September are usually very weak months in any given year, so it could just be possibly that we're deleveraging coming into those months. Number 5, technical correction. Well, this obviously goes with all the above points. You guys know semiconductors and big tech have been on an absolute tear, citing concerns or raising concerns rather about over market concentration into so few names. Well, those names have run a lot into overbought conditions, and now we have a little bit of overbought technical correction happening right now where a lot of those big names have pulled back 8, 15, 20%. Now, number 6, we have a big tech earnings de-risking because of the performance by Netflix, Google, and now Microsoft. A lot of people just anticipating maybe that tech earnings won't be as good as planned and could see some future declines. So that's why you've seen money rotate out of the sector as a whole. And lastly, we have the consumer spending recession worries. Those were voiced by Starbucks, Pepsi, McDonald's, Coca-Cola, Walmart, the dollar stores, and UPS. So everywhere that's directly exposed to consumer spending, guys, have been showing weaker and weaker sales, especially in the last 3 months, which really raises concerns. How much longer can the consumer keep spending before they run out of savings, right? Because we obviously know that the wages are just not doing the job right now. So for all of these reasons, we've been having a more tech concentrated sell-off, but an overall broad market sell-off to say the least. So with that out of the way, guys, before we get into more technical analysis, let's dive into our earnings plays right away. And we're going to start off with the biggest one of the day, guys, and that is going to be Microsoft. So what exactly happened to Microsoft, guys? They were down at one single point in the after hours today. Let me just turn on the extended trading hours right here. Look at this drop on Microsoft, down about 7.5% before recovering a little bit. That is very uncharacteristic for Microsoft, but just goes to show you the landscape that we're in right now. However, the company did a fantastic job on earnings, guys. Triple beat. Beat on EPS, beat on revenue, and raised guidance, and still fell. Beat on EPS here by about 0.48%, and a nice beat on revenue by about 0.4%. So let's take a look at exactly what happened through Microsoft's earnings. Some of the concerns leading into the earnings should give us a good hint as to why the stock dropped. So here's an article that was written yesterday prior to the earnings. Microsoft's cost in focus as fears rise over slow payoff from AI. Same concerns about Google. Now, has growth in Azure cloud computing business picked up enough to justify the billions of dollars being spent on artificial intelligence infrastructure? Microsoft's capital spending likely surged about 53% year over year to $13.5 billion in the period, a big step up from the $11 billion in expenditure it recorded in the previous quarter. So they're spending more and more money on AI. Is it justified, and can they afford it? We will obviously look into that together, guys. Shares of Google parent Alphabet fell more than 5% last week after the company reported a capital spending that exceeded estimates by nearly $1 billion, while the revenue boost from AI integrations remained modest, sparking a sell-off in major tech companies. Alphabet said quarterly capital expenditure would stay high for the rest of 2024 at or above $12 billion, so them and Microsoft are not done spending. Investors will be very focused on Microsoft's ability to continue to accelerate revenue growth, especially the portion related to AI. If revenue acceleration doesn't materialize and increases in CapEx continue, investors may be disappointed. Microsoft has said it needs to spend on data centers now to overcome the capacity constraints that are hampering its ability to capitalize on AI demand. Here is what the CEO of Google had to say about this last week. The risk of underinvesting in AI is dramatically greater than the risk of overinvesting. And I do agree, guys. And if any companies have money to blow on this, it is definitely big tech. So we're going to take a look at that when we look at the free cash flow numbers in just a few short minutes. So here we go. What happened today? Microsoft shares drop as cloud miss overshadows better than expected revenue and earnings. Take a look at these revenues, guys. The revenues were fantastic. Revenue increased 15% year over year. That is definitely not nominal, guys. It's a $3 trillion company, and they're still increasing revenue at a double-digit rate. Very, very solid in my humble opinion. The company's top segment, Intelligent Cloud, generated $28.5 billion in revenue. It includes the Azure Public Cloud, Windows Server, Nuance, and GitHub. The total was up about 19%. However, it was below the consensus. That's the only reason, guys. How much was it below the consensus? 0.6%, but 0.6% was enough for Wall Street to drop the stock 7% in the after hours. A little bit of an overreaction in my humble opinion. We're going to dive into why. Revenue from Azure and cloud services grew 29%, but analysts had expected 31. So a little bit of a slowdown here in Azure, which is the most watched line of business for Microsoft right now. And meanwhile, Google Cloud Platform, which is one of their direct competitors, also was up 29%. So they were up roughly the same quarter over quarter. Now, Amazon is obviously the industry leader in that aspect. Of the 29% growth for Azure and other cloud services, 8 points came from AI services. So it goes to show, guys, that they are monetizing AI, just maybe not enough to Wall Street standards. Take a look at all of the lines of business of Microsoft, guys, and you will see it is a very good picture. This company is so solid, which is why I deem that this earnings sell-off is a decent buying opportunity. Azure and cloud services, 29%. Dynamic products and cloud services, 16% quarter over quarter growth when measuring across a year prior, right? Office 365, here's your consumer segment, right? Commercial and the commercial applications for 365, 13% growth, very good. Consumer segment of Office, 3%, but still growing. You would see they haven't really missed in the last 2 years across these segments. Search plus news advertising, 19% gain. That's very good. Server products and cloud services, right? So they're enterprise applications for data centers, 21% growth. Very good. Now you can see Windows Commercial and Windows OEM. So their Windows suite of products up 11% commercial and 4% for consumers. Very solid numbers, guys. And look at their Xbox gains. 61%. Absolutely fantastic numbers from every single line of business in Microsoft. But because Azure came in at 29% growth instead of 31, and because the whole cloud segment only missed by 0.6%, you get a 7% drop on Microsoft. A little bit overblown in my humble opinion. Let's continue. So into Microsoft's actual numbers, you guys will see how great these actual numbers are. Take a look at your net income figures for the quarter, guys. Microsoft net income, 34%. Definitely not a problem at all. I'll remind you, Microsoft usually operates in the mid 30 percentile range in terms of net margins, and that's pretty much streamlined with the last 5 quarters, right? 34, 35.5%. So very decent net income results from Microsoft just the same. Now, I'm sorry, I just closed the tab, so let me just reopen it again. So moving on here, guys, I just want to highlight one last thing, and that is going to be the free cash flow. Why are we going to focus on the free cash flow? Because the concern right now is that these companies are spending too much money on AI and they may not be seeing the revenue growth for it, which begs the question, do they have money to blow on these projects? Well, let's have a look, guys, in terms of their net free cash flow. So all you got to do is take net cash from operations, which is 37 billion, minus the additions to property and equipment, which is what everybody's criticizing. You can see they had $23.3 billion in free cash flow in the quarter. Is that standard for Microsoft, or is it better or worse? Well, that's why we have the free cash flow history right down here. And you can see in the last 5 quarters, guys, look at the free cash flow, right? 17, 19, 20. This most last one, the quarter prior ago, 21. Despite the amount of investments that they've been making, they posted record quarterly free cash flow, guys. Insane numbers by Microsoft. Just goes to show they do have money to spend on these endeavors, and it is going to be worth it for them in the long term. If you don't believe me, take a look at the 12 months ended. This is your trailing 12-month free cash flow, 118 billion minus the 44 billion in capex, $74 billion in free cash flow for Microsoft. That is going to be their best year ever on record, guys, right? Free cash flow was always between increasing from 45, 56, 65, 60, and now trailing 12 months, we are at 74 billion. Record free cash flows trailing 12 months and quarter over quarter. Fantastic numbers, guys. They have money to spend on these AI projects, and I do not think they're spending too much. The proof is in the actual numbers. Their free cash flow numbers are growing at record paces, so no problems there at all from Microsoft. As a matter of fact, look at this free cash flow growth in the last 15 years, and you can see it's absolutely exploding. So the $74 billion number is going to be a lot higher than this chart displays right now. So very nice free cash flow progression by Microsoft. Nothing bad to say about the company at all whatsoever. Just a little bit of an overreaction by Wall Street, in my opinion, because of all the factors we discussed in the introduction of the video, right? Concerns over big tech, which are being a little bit blown out of proportion in my humble opinion. So that being said, let's take a look at the valuation here, guys. At the current price, which in the after hours sits right about 406. Now, I did this one with 395 because that's where it was when I did the analysis, a bit lower. But you can see, guys, growing revenue and EPS 12.5% and 14.5% per year. This is a $3 trillion company, which is arguably one of the more value-oriented tech names, right? Still growing EPS fantastically, still growing revenue fantastically as well. So giving them a forward PE ratio at $395 of 33.4. Not that bad. That's within Microsoft's historical averages. Now, the PEG ratio at 395, we just divide this PE ratio by the EPS growth, gives us the price to earnings growth ratio, one of the best metrics to evaluate different companies amongst each other, and we get a 2.3, which is a little bit rich, guys. Microsoft always usually trades a little bit rich, just front and center. I have to put that out, guys. So very rare to find Microsoft trading under a 2 PEG unless the entire market is severely crashing. So this is really in line with their historical averages, and free cash flow yield, you want to be looking for about 3.5% to 5%, but similar, guys. It's very, very rare to find Microsoft trading above a 3% free cash flow yield. It just doesn't happen much because the company is so consistent and so predictable that Wall Street gives them a higher valuation because of the defensive nature of the company being in the tech landscape right there. So the valuation right now, I'm not opposed to buying, and even on the technicals, we'll view them a little bit later, guys. 406 down to 400, my ideal opportunity to buy. Microsoft would now be pretty much off the highs, about 14%. And we'll go through this later, guys. Usually in the past weekly history of Microsoft, you can go anytime in a bull market. Usually when we start buying this company, 14 to 18% off. It's usually been a very attractive proposition the entire way. So swing trade on Microsoft down to these levels, yes. And long-term position for a portfolio, I shouldn't even have to say this one, but yes, yes, yes. So that's pretty much everything for Microsoft. Hopefully you guys enjoyed that one. Now, let's dive into earnings number 2, which is going to be AMD. So AMD obviously had earnings after the bell as well today. Let's take a look at exactly how they did. AMD right now is up very nicely in the after hours, up about 8%. So what exactly did the company say and do for them to be up 8%? Take a look at this, guys. Triple beat. So beat on EPS, beat on revenue. You can see right here, beat on EPS, 1.79. Beat on revenue, about 2%, and they raised, which means they raised their guidance, which is a triple beat for AMD. So let's get into the articles for AMD, shall we? So AMD data center sales more than doubled in a year. This is going to be their biggest line of business by far. So nice to see that that expansion is finally coming. We've been talking about this for a while on the channel, guys. AMD has been doing a great job of investing a lot of money over the past 6 to 9 months to scale out their data center offerings and start to challenge NVIDIA as the leader in the business, right? So take a look at this EPS ramp. You can see that most of the EPS gains will come 2025 onwards when their data centers are up to scale. Same thing for revenue. That really starts exploding as early as next year. As so far, still 2024, a little bit of transition year, but the end of 2024, so second half where we are right now, that is when the exponential ramp starts, and 2025 is really the boom period, right? So let's take a look. So moving on into AMD. So let's have a look right here. I don't think I highlighted anything. My bad, guys. I must have chosen a different one here. So let's go over it together, right? So they reported second quarter earnings on Tuesday that beat the expectations and showed continued growth in the sales of the company's AI chips. Very solid quarter for AMD as a whole. They expect 6.7 billion in sales in the current quarter. Excessively good here, guys, right? Investors want to see AMD take market share away from its longtime rival NVIDIA and signal growth in its data center AI business, which they are indeed signaling right now. So looking very, very strong, guys. As a whole, instead of reading this article, you know what we're going to do? We're going to go right into the earnings because that is where I really outlaid everything better. So let's take a look at some of the AMD highlights right now. Quarter over quarter growth, 9%, right? Or excuse me, year over year growth, 9% in revenue growth, largely fueled by their data center. You can see data center revenue far now outweighs every single other line of business. Data center was up over a 2x year over year. Client revenue as well, 49% to the upside. Gaming revenue still struggling a little bit with that cyclicality, down 59% year over year. They've been struggling with that for the last 2-3 quarters. And embedded revenue down 41% as well. If you don't know what embedded revenue is, guys, AMD caters to commercial applications. Let's say a business wants to order, let's say 100 to 200 desktops for employees, right? Well, the chips that AMD puts in those Dell or HP desktops or whatnot, that is called embedded revenue. Unfortunately, that was down 41% year over year. Gross margin, however, improving 3%. Very, very nice. and non-GAAP gross margin as well, operating very nicely too. So let's take a look at some of the business highlights in terms of their segment breakdown, guys. And you can see that everything was very, very healthy for AMD as a whole. I just want to bring you guys, your guys' attention to their revenue breakdowns, right? So nice increase in revenue, nice increase in gross margin as we just seen, EPS increases, which are very, very healthy too. Nothing really bad to say about the company. Improvements in gross margin is what everybody is really looking for here, guys, because they've always really had a margin problem. And AMD is not NVIDIA, right? Their net margins are not very strong right now. They should be expanding with data centers, but you can see AMD's net margins in the past couple of years have only been about 4, 5, 6% at best. So people really want to see them start expanding that. So nice to see that they are finally starting to expand a little bit on their gross and net margins as well. And we do expect that to continue into next year as they ramp up their data center offerings, right? So as a whole, guys, not too bad for AMD's past quarter, right? All in all, fairly decent quarter. This is exactly what I wanted to see. I wanted to see their data center business start severely ramping, and that is exactly what we're getting into right now. Now, let's take a look, guys, at some of the valuation. That's pretty much everything. We can go through further of their segment breakdowns, but in my opinion, data center is really the big focus, and they crushed it on this one, so we'll just pretty much go with that, right? Now, in terms of the valuations right now, we can see revenue expanding nicely, 13% per year, EPS expanding nicely also at 35% per year, which is extremely strong. Once again, bolstered by that 2025 and 2026 growth, which gives them a valuation right now at about $145 in the after hours of PE, a forward PE for 2024 of about a 41.3. Not too bad, especially when we divide that by their EPS growth rate, gives us a PEG ratio of 1.18, which is very, very, very cheap, guys, especially in comparison to a lot of their competition in the semiconductor space, right? Now, I know nobody truly does exactly what AMD and NVIDIA does, but if you take a look at all semiconductor names independently, who has some of the best PEG ratios, AMD is probably top candidate, followed closely by Taiwan Semiconductors. So the valuation on this one is pretty good indeed. So in terms of a swing trade, could definitely be a nice little location to restart a swing trade and start attacking the higher 150s, 160s with renewed bullishness in the business. And a long-term investment, guys, I also consider it's a good opportunity to start nibbling at some shares in these lower to mid $140 ranges. I think this company should be excessively higher come the end of 2025, and analysts tend to agree with me as well. The median price targets are usually between $190 and the mid $200 range, so a lot of potential upside for AMD to come. So that's pretty much everything for AMD earnings, guys. Just keep an eye on their profit margins. That's going to be the one thing for AMD in my opinion. You can see they're improving gross margins over the last 4 quarters, improving operating margins after getting crushed in 2022, and improving their net margins ever so slightly as well. So they're on the up and coming, guys, but this trajectory is what everybody should be paying very close attention to. Now, earnings number 3, guys, we're going to be covering Starbucks. So Starbucks actually up right now 5.35% in the after hours. But guys, they missed on everything. This is kind of like a bit like McDonald's, right? Where they miss on everything, but the expectations are so low that if they don't come in lower, right, then the stock could potentially rise. So earnings are very, very funny in that aspect, but Starbucks did not have a good quarter at all. Let's not get it twisted, guys. Very bad quarter for Starbucks. EPS missed by about 0.5%, revenue missed by 1.45%. Again, double miss and lowered guidance by Starbucks once again, guys. It was not a very good quarter at all for them. Take a look at these numbers, guys. Net revenues down 1%. However, in relation to last quarter, which was one of their worst quarters in memory, they were actually up 6%, but still, guys, down 1% year over year is just unacceptable for this company, right? Now, they say that their action plans in terms of cost cutting and business restructuring are offsetting the continued headwinds. I'm a bit mixed on this one. We will have to see 6 months down the road whether or not that's the case. One positive point is that their loyalty memberships rewards, right? Membership programs up 7% prior year and up 3% over last quarter. So at least they have a loyal customer base. It's nice to see them retain memberships in terms of that aspect. But that's pretty much where the bullishness stops, guys. It gets really bad from here. Global comparable store sales declined 3%, driven by a 5% decline in comparable transactions, partially offset by a 2% increase in average ticket. So their prices are a little bit higher, but the foot traffic in the volume is way down. North America comparable store sales declined 2%, driven by a 6% decline in comparable transactions. Not good at all, guys. Less people, right? Less money However, it was offset by their increases in prices, right? So the volume's going down. They've offset it a little bit by their heightened prices, but they've run out of pricing power. People have said no more whatsoever. It's not as if they can raise prices anymore. If anything, they're cutting them, and we'll get into that. International comparables, that was their North America segment. Listen to international, it's even worse. International comparable store sales declined 7%, driven by a 4% decline in average ticket and a 3% decline in comparable transactions. There, everything was bad, right? Not only is volume down, but pricing is down as well. China comparable store sales declined 14%. That is terrible, guys. They made a massive expansion phase during the pandemic, Starbucks into China, and so far it has just not been going well for them at all. 7% decline in both average ticket and comparable transactions. Very, very bad. However, the company, despite this, has found a way to open 526 net new stores. Now, here's some comments by management. Our three-part action plan is beginning to work and driving operational improvements that we expect to improve financial performance. In other words, we're trying to cut costs where we can because we know that we'd have no more pricing power and we know volumes are going down. So in order for us not to get our margins further crushed, we have to cut costs and potentially maybe even lay off employees. Our efficiency efforts, which are tracking ahead of expectations, partially offset investments associated with the cautious consumer environment. So more of the same. Take a look at these segments, guys. If I lost you during the numbers, let's see them visually. Q3 North America segment, right? Transactions down 6%. Ticket price, however, is remaining quite high in relation to last year. So at least they're partially offsetting it a little bit, but guys, but it doesn't really matter because the overall operating income, the profit was down 2% in North America. Not a good look. International segment as well. Take a look at this. Comparable store sales, 7% down. Change in transactions, 3% down. Change in average ticket price, down 4%. So they've had to reduce prices in China to try and attract people, but it's not really working too well. Maybe it is. Maybe these numbers would have been worse if they didn't decrease prices, but still, operating income, their bottom line profits, guys, right? 23% to the downside. Terrible look for Starbucks, in my humble opinion. However, all throughout that, what I wanted to point out to you guys is number one, let's take a look at some of their expenses, right? So some of their expenses, they've been keeping them somewhat under control. We can see their store operating expenses, that is only up about 3.6%. It could be a lot worse. At least it's not more. Other operating expenses as well, they were up 3.7%. So the company is trying to control costs as best as it can, but still the costs are outpacing the gains in revenue, which are actually negative right now, right? So unfortunately for them, not a good look, which does impact their bottom line net margins. Net margins are now down to 11.5%. And last year at the same period of time, they were about 12.4%. So keep a very close look, guys, on Starbucks operating profit margins. You can see that they were decent, but now you can see for now 2 quarters in a row, this quarter is not posted on this website yet, but they are starting to decline. Net margins are coming down. Operating margins are coming down as well. Not a good look for Starbucks. If they cannot turn this around in the next 2 quarters, I don't think that their stock price is going to appreciate it too much. Now, taking a look further, guys, were they able to at least generate some free cash flow to continue paying the dividend and maybe start doing some share buybacks? Well, surprisingly, they actually generated some decent free cash flow right here because they pulled back a lot of their capital expenditures. They weren't opening as many stores as they had planned, in other words, right? So take a look, net cash provided by operating activities, $4.5 billion. And then they used a bunch of that to for some investments in their property, plant, and equipment, of course, right? So if we were to do just a minus right here, you can see if we just do, sorry, I didn't label it on the chart right there, 4,560 minus your 1,979 gives them free cash flow this quarter of 2.6 billion. 2.6 billion of free cash flow, guys, is not that bad in the grand scheme of things. The last quarter was significantly worse than that. They had negative free cash flow, and the couple of quarters prior, you can see nowhere close to the $2 billion mark. So at least they're pulling back on investments and starting to hoard a little bit of cash, really starting to plan to weather out the storm. So at least that's good, guys. The company is acknowledging they have a problem right now. They're cutting back on costs as much as they can, both operating expenses and investments into new ventures as well, starting to hoard a little bit of cash, which maybe could lessen the blow a little bit. So take a look at this, guys. This was the resume, right? Improvement over last quarter, large expansion in China during COVID, now struggling, domestic sales continue slowing, pricing power crushed, forced to reduce prices, the margins are at risk, but somehow the free cash flow is still decent, so no jeopardy of the dividend being at risk, and maybe even have a little bit for share buybacks. Now, keep in mind, revenue growth for the next foreseeable future is 7.1% per year. EPS growth is slated to be 13% per year, but I would not be surprised if these estimates are reviewed to the downside, right? Supposedly, Starbucks will be expanding EPS through 2025. Still remains to be seen if that's the case. And revenue expansion is slated to be nice as well. So at a first glance, these look okay, but keep in mind, Starbucks may have a few more rough quarters ahead of them. In terms of valuation right now, at $77 in the after hours, they get a PE ratio of 21.5. At a first glance, it doesn't appear to be too high. If we divide this by the earnings growth rate, we get a PEG ratio of 1.65. Now, I know, guys, anything between 1 and 2 is sometimes okay, but I wrote okay ... just because of the uncertainty surrounding this brand, right? We don't know whether or not they'll be able to support this EPS growth rate over the next few quarters, or at least over the next year. So we may have to revise this to the downside, which would make this the PEG ratio go a little bit higher. So Starbucks, even though it may appear cheap right now, being pretty much off the all-time highs by about 40%, I can actually tell you, right? We just looked into AMD. AMD has a better PEG ratio than Starbucks. That's crazy. Facebook has a better PEG ratio than Starbucks. A lot of other companies have far better valuations than Starbucks, even though Starbucks is 40% off of the all-time highs, right? So just because a company is 40% off the all-time highs does not mean it's cheap, guys. In terms of Starbucks, for me, still a no trade for me, right? Yes, there was an opportunity to potentially swing trade this negativity and maybe take us back up into the $80 range. Of course, guys, but I just don't like this one, nor for a swing trade, nor for a long-term investment. And in my opinion, there is far better companies out there than Starbucks at the current time. And especially given the current consumer landscape, I would not be personally touching this one, at least for the next 3, 4, 5 months, guys. It's just not the best company right now. They're struggling a lot, and their international expansion is really not going as planned. So a lot of things working against Starbucks, but happy to see that for people who are invested, it was up about 5% in the after hours. Hopefully those gains actually maintain into tomorrow. So moving on in, guys, let's cover our last one that we have prepared for you guys for today. Try to go through this one as quickly as possible. So we're going to be looking into PayPal. So PayPal was up today after their earnings this morning, about 8, almost 9%. PayPal at one point this morning was up more than that. They were up about 10.25% before retracing a little bit. So what exactly happened, guys? PayPal had a triple beat on EPS, beat on revenue, and they also increased full year guidance. A very good look for them. This is what we were waiting for. And I'll explain when we get into the numbers, guys. Beat on EPS, this is massive, guys. 21% beat on EPS almost, and a 0.79% beat on EPS. I'll remind you, what was PayPal trying to do this year? PayPal has said that this year would be a little bit of a transition year for them. Do not expect revenues and total payment growth, our total payment volume growth, to be going astronomically higher. What they're trying to do this year is focus on cost efficiency, reduce share-based compensation, reduce operating expenses, improve profit margins. That is their quest for this year. And then next year, they will be targeting top-line growth revenue expansion with the cost savings of this year. So that's a quick, little introduction as to what PayPal is trying to do right now. So let's get into some of the articles. PayPal lifts 2024 profit forecast for the second time. Branded checkout growth outperforms. Decent earnings for them. Nothing bad to say about their earnings this time around. They raised their full year adjusted profit for the second time, as we just said. Now, a big thing was this following point, guys. Tech giants Apple and Google have expanded into digital payment offerings in the recent years, causing analysts and investors to fear that they will take a bite out of PayPal's market share in its mainstay business. Here's what the CEO had to say about this. If we narrow down into desktop and web, which is 40 to 50% of all checkouts, we see no degradation in our share over the past 4 years. We have held share despite competition. However, notice he did not address mobile. I'm pretty sure that Apple and Google are taking away market share from PayPal in the mobile segment, but the CEO saying that it is not manifesting at all in the desktop checkout business, which is 40 to 50% of all their checkouts. So it remains to be seen whether or not Apple and Google can claw away at PayPal's mobile business. Now, PayPal is betting on continued spending resilience through the key back-to-school and upcoming holiday shopping season. This is a big one, guys. They're betting on continued spending resilience. If they do not get it, their plan will not come to fruition. Very important here, right? This is a huge assumption by PayPal. The company now expects adjusted profit growth in a low to mid-teens percentage in 2024, compared with its April forecast of mid to high single digits. Mid to high single digits, guys, is about 7, 8, 8.5%, and now they're guiding for low teens, for a net improvement in profit growth, that is for sure. While a gross profit beat was expected, magnitude of the upside surprised positively, analyst at Jefferies said. So very good for them, improvements in profit margins, which is exactly what the company's been trying to do this entire year. So nice to see that they're executing on their plan. Now, let's take a look at some of their numbers here, guys, and you will see that the numbers are actually very good for PayPal. I was quite pleasantly surprised over this one specifically. So total payment volume up 11% year over year, back to double-digit growth, finally. For the first time, guys, in about, let's call it about 5 quarters, so almost a year and a half at this point, finally back to double-digit total payment volume growth. Revenue growth, 8%. Not quite double-digit percentage, but very decent nonetheless. Now, let's get down into it as well. So active accounts, not much changed, but monthly active accounts, increase of 3%. Better than nothing, I assume. Number of payment transactions, that is up 8%. And transactions per active account was up a whopping 11%. Very, very, very good here, guys, in terms of those numbers of their active members, right? Now, in terms of further metrics, we can take a look at this, right? So transaction margin, which is very important for PayPal, up 8%. That is what analysts were talking about, being happy that they have very good profit margin expansion, right? So non-GAAP operating income was up substantially 24% year over year. Obviously, one of their other profit metrics right there. Non-transaction operating expenses were down 1%, driven by higher productivity and lower share-based compensation expense. Cost savings were reinvested in key growth initiatives. So not only have they cut back on operating expenses, they've cut back on capital expenditures, right? Very important to do those two things. We just touched upon this with Starbucks, highlighting the importance in an uncertain market condition right now, the importance of cutting back on operating costs to run the business, but also the amount of new money that you pour into future endeavors, right? Cutting back on both will shore up the balance sheet and also benefit profit margins. Now, take a look at your guidance, guys. This was one of the reasons that the stock had a very significant increase in share price today. So look at the increase in guidance, guys. Non-GAAP EPS, prior low to mid-teens growth, now mid to high single digit growth, now low to mid-teens growth, prior mid to high single digit growth. Very good for EPS expansion. That is profits translating into EPS appreciation. Free cash flow, very nice guidance as well. Approximately $5 billion of free cash flow for the whole year. Now they're guiding to $6 billion, improvement in free cash flow guidance. And share repurchase guidance as well. At least $5 billion was the guidance back in April. Now they're saying about 6. So they raised everything. Raise in profit margins, right, as valued by EPS. Raise in free cash flow, and raise in share repurchases. Very, very solid. Couple that with total payment volume growth, as we saw above right here, right? Very, very, very healthy results by PayPal as a whole. Nothing bad to say about the company as a whole. They really raised the bar in every single metric that's important. And if you don't believe me, guys, let's take a look at their cost structure right now. So you can see, right? 6 months ended June 30. Look at 2023 numbers right here, 840. Transaction and credit losses, down in terms of expenses, right? Customer support and operations, down year over year. Sales and marketing expenses, down year over year. Technology and development, their R&D, a little bit the same, but they maintained it the same. They're not expanding. Cost control is the name of the game. General and administrative, this was ever so slightly up prior to the current year, but still not up a substantial amount, right? Only about 3% to the upside, which gives them a very healthy profit margin, guys. PayPal finally bringing in 16.7% of net profit margins. I'll remind you, the problem with PayPal in the most recent history of the company, right, has been a profit margin that was kind of stagnating between 13 to 14%. But look at this. Even last quarter was about 11, right? But now we're back to very nice growth. PayPal's margins on a yearly basis at best were 16 to 19% during the pandemic years when everybody was using P2P transfer systems, right? PayPal's best years were then. Nice to see that they're finally back to mid-teens, right? Profit margin, oh, you can't even see it, guys, my bad. Mid-teens profit margin expansion, 16.7% net margins. Very decent quarter for PayPal, guys. I'll remind you, PayPal profit margins, right? They were on a declining in gross, but now look at the operating margins, guys, getting more efficient in the business. And net profit margins, take a look at from the bottoms of 2022 when the stock got absolutely crushed at least we are getting better and better and better. The company is following the accurate trajectory that we want to see. So that being said, let's go over a few of the highlights and then we're done. So right, a bit of a recap. Resilient despite consumer slowdown. That's an assumption. Remains to be seen if it will maintain true. No sign of competition erosion from Apple and Google, at least in desktop. Still no certainty about mobile devices, and nobody has really provided that data. Apple hasn't provided it, Google hasn't provided it, and PayPal, I went through their entire earnings presentation. They haven't provided it as well. So remains to be seen on this front. Now, total payment growth for the second quarter in a row, very good. Good margin expansion back to growth, and active user growth remains in expansionary territory. Revenue growth and EPS growth over the next foreseeable future should be fairly good. I'll remind you, what is their growth curve? 2024, a little bit of a transition year for them, and then 2025 and onwards should be resuming to growth. Revenue, pretty much the exact same thing. So 2024 is still a little bit of a transition. In terms of their valuation, at $64, the price in the after hours, PE ratio, a very tiny 15.3, but when we divide this by their EPS growth rate, we get a peg of only 1.16. If I had to bet on a recovery story between PayPal and Starbucks, I would personally go for PayPal just because they're operating in a little better of a landscape. They have less headwinds facing the company, and because their valuation is lower, right? So this one could be looking good for a little bit of a swing trade. If we back test this location right here, 62 down to $60, right? This big area of prior resistance should now be support, looking for maybe a breakout towards the 70s. I do see a little bit of a swing trade there, and a long-term investment, guys, will really determines on your view of whether or not PayPal can start really becoming or recapturing its status as one of the industry leaders in the payments processing division, right? They are one of the industry leaders right now, but their growth has been called into question. So if you do believe that PayPal's best days are still ahead of it, this could be a very a nice long-term investment play as well. I would not be opposed to starting a very small feeler position for PayPal and just letting it ride thereafter, right? I'm not expecting a balloon growth like this, but could we have some sustained gains over the long-term future, over the next year, 2 years? Absolutely. I would not be surprised. And the analysts as well, a lot of their price targets are anywhere between 76 all the way up to about the mid $100 mark. So we do still have some decent upside remaining for the stock if they are able to manage their costs and continue growing efficiently. So all that being said, guys, that's everything I had for you guys in terms of earnings. Sorry, there was a lot there, but we have to cover some of the biggest companies in the world. So hopefully you appreciated that. Now let's dive into some technical analysis, right? So technical analysis, guys, as I said once before yesterday, we are pretty much beholden to tech earnings this week. Now, after Microsoft's decline, guys, the futures had a disaster, right? So we really came down hard after those Microsoft earnings, or excuse me, after the Microsoft earnings right here. But we're looking to try and find a temporary bottom. Everything relies on tomorrow, guys. Tomorrow, such a huge day. Not only Meta, ARM, Qualcomm, Lam Research, and MasterCard are reporting, but obviously Jerome Powell is coming in as well, right? So it's really anybody's ball game still in terms of the price action. It's very, very tough for me to say that the bulls are going to be able to respect certain levels when we have such high volatility coming, right? As of now, daily downtrend is maintained. We are potentially expecting a lower low if earnings remain unfavorable for the week and if Jerome Powell remains bearish, right? That being said, the bulls do have a chance at some expansion here. If we were to break the highs of the most recent 3 days of trading, that would be, especially with today's move right there on the SPY, right? We have set a temporary higher low. If we now crack the highs, SPY would actually regain the daily uptrend. So these levels are absolutely crucial. However, if tomorrow is a bad day and we break the last lows of last Thursday, daily downtrend simply continues. And I pretty much tell you guys that we may be coming into this support level right here, 530 down to about 515 on the SPY. In terms of that sell-off, if we do come down there, that would be about a 5 to roughly 8% sell down on the SPY. Last April, we got about 6%, and last fall, we got about 10%, right? So coming into this range could be pretty much the bottoming out territory for this short-term consolidation in the markets. This is going to be the larger area where I'm very curious to see if the bulls will be able to respect. So this week, it is still anybody's guess, guys, as to the short-term price action. There is too many catalysts, Jerome Powell, NFP jobs, and all of the remaining earnings from big tech. Too many catalysts for us to take a definitive stance on the short-term price action. Moving into QQQs. QQQs, exact same thing. So unfortunately, daily downtrend on the Qs does continue, as opposed to SPY, which is setting a somewhat of a daily higher low and has a chance at a daily trend recapture. QQQ has broken to the downside. Daily downtrend remains intact. And if big tech earnings and the rest of tech slides in tomorrow's session, guys, well, unfortunately, we will be sliding into our big support zone. right? So on the QQQs on the weekly, that is 450 all the way down to 434. Pay special attention to this guy right here. That is 445. Lose 445, that is a loss of the weekly uptrend, and it could take the QQQs bulls a while to reset in uptrend in motion. But I do believe, guys, this area of support is going to be a very big one. If we do dive into that location, that will be a 10 to 13, 14% sell down on the Qs. And in the month of April, we got about an 8% correction. And last fall, top to bottom, we got about an 11% correction, which is why I say this area could possibly be the extent of the damage on the QQQs. So we will be very careful and mindful of all the volatility events for the rest of the week, whether or not we can come down into this big support zone with maybe oversold conditions. That would be a heck of a bounce trade opportunity. Moving into financials right now. Financials acting as if nothing was wrong in the markets whatsoever because the rotation into value and financials simply continues. Financials are going to be favored with a rate cut in the month of September, right? So right now, what are we looking for? Daily downtrend was set. Big engulfing move by the bulls. So now the bulls have created a ton of space above 42.57 to eventually be able to reset into a daily uptrend with setting a daily higher low into a daily higher high. Nothing bad to say at all. And take a look at your weekly uptrend, guys. Weekly uptrend is absolutely beautiful for the bulls. Even if we do have some extended consolidation and we lose this, guys, what are we just looking for here? Just looking for a weekly higher low for continuation of the uptrend. Keep an eye on your prior resistance at the all-time highs, which is going to coincide rather with the 12 EMA curling up into this area. So 42.40 could be a very decent breakout, retest and run area for the bulls. Moving into XLV healthcare right now, healthcare has been maintaining, decent levels in the past couple of days and is still in somewhat of a daily uptrend right now. This is pretty much one single move because we have series of higher lows pretty much every single day, right? So pretty much stair-step pattern to the upside, looking pretty good. That being said, we're really struggling with the all-time highs, 151.19. So if ever we do choose to break down on healthcare a little bit, just know we have a lot of space. Anything above 147, just going to be looking for a daily higher low to potentially continue this daily uptrend a little bit higher. At worst, we may just get some sideways consolidation as the market continues to operate in very timid conditions right now. One thing is for sure, however, on the weekly, on the higher time frames, everything's looking gorgeous. Oh, this used to be all-time high resistance. It's now going to be support. So even if the bulls lose a little bit of ground here, what are we looking for, guys? Just looking for a weekly higher low for continuation of the uptrend later on in the year. Healthcare should perform very well with this value rotation and with rates coming down. This whole area right there, 147 down to 144, could be beautiful support. Break out of the all-time highs, retest, and maybe run for the bulls. That could be on the table. Now, looking into semiconductors. So semiconductors down 3.83%, but recovering very nicely in the after hours due to the AMD earnings, right? A lot of different companies have been recovering in the after hours. Take a look at NVIDIA right now. NVIDIA was down 7% on the day today, recovering more than half of that in the after hours right now. Let's take a look at a few other big names. ASML recovering about a percent, right? So recovering almost all the losses intraday. TSM, another big one. They were down, 3.42%. They are now up 2.4% in the after hours because of AMD earnings. Now take a look as well, AVGO Broadcom as well, recovering more than half of the loss in the after hours that they had over the course of the day today. So semiconductors could be having a little bit of a bounce in the tomorrow session. However, guys, we need to understand who is in control right now. Clear daily downtrend. Even this bounce, guys, maybe just looking for a lower high. And then if ever earnings tomorrow, guys, keep a very close watch. ARM, Qualcomm, Lam Research. If ever those are not well received by the market, we will just continue this daily downtrend into lower and lower levels, which will extend our weekly consolidation as well. Keep a very close eye on this daily RSI, guys. I'll move it over a little bit. Almost oversold conditions. Keep an eye, guys. This is one of my favorite trades to make whenever from a previous all-time high, we get daily oversold conditions. It is usually a very good catalyst for a bounce trade. So if we continue to approach oversold conditions after tomorrow with tomorrow's earnings, and we get oversold conditions on SMH, it could be a very nice criteria for a short-term bounce. Target as well, this area right here, 215, 214, that is the 200-day moving average right now. We're currently pulling in to this area of support, the bottom of which is 225. Any lower than that, guys, and we unfortunately have to go into our lower area of support, which would be these guys right here, right? You can see clearly a little bit of resistance right here, previous resistance, a little bit of support. That could be acting as a next level, and that would be pretty much 208 down to about the $200 mark. So semiconductors as a whole, guys, weekly is right now in a pretty much weekly consolidation trend, and as well on a monthly consolidation run as well. So all in all, guys, I don't really deem that anything has changed in the semiconductor market whatsoever. None of these businesses have been really affected in the last 2-3 weeks. The fundamentals haven't changed. What has changed is people's perception on the AI narrative and people's penchant to rotate into value names because they feel that maybe the gains in the AI narrative have been had already, and now they're chasing gains in a whole other segment of the market that's been left behind for arguably the past year of trading. So semiconductor sell-off is, in my opinion, warranted. But have any fundamentals changed? Absolutely not. And I do remain a buyer, guys, if we do come down into oversold conditions across a lot of different names. Moving into IWM Russell right now. So the Russell ending about 0.38% to the upside, still very solid sideways accumulation, right? So they're trying to set up a very, very tight range of accumulation here at the most recent 52-week highs. What are we battling with, guys? We're battling with this whole area of above resistance above us, and that is pretty much 225 up to 231. Huge area of resistance from 2021, and I do believe that will continue as a whole. So for the bull break, guys, we're obviously looking for a clear break of 226, which would put our daily uptrend back in motion. However, if we lose the low end of this range, if let's say the market continues consolidating and IWM cannot keep its gains up, well, unfortunately, guys, that would maybe be daily downtrend in motion, and we would just be looking for a weekly higher low. This is the trade that I am personally looking for. I don't want to chase IWM right here coming into a big area of resistance. The trade that I'm looking for is weekly uptrend, breakout of a huge range of consolidation, looking for the back test, guys. If I can get a back test, let's call it 211 down to about 208. If I can get a little back test of this region right here, that could be a very nice opportunity for some long form continuation. That is the trade setup that I'm looking for myself. Moving into the Dow Jones doing what it does best when big tech is consolidating and the value names take over. The Dow Jones usually tends to outperform the S&P and the QQQs, and that has been the case over the last couple of weeks. Take a look, guys, right? So daily downtrend right now, big engulfing move by the bulls. They've created a lot of space above 39,800 to eventually be able to reset into a daily higher low and change this back into a daily uptrend. On the weekly is also looking very good. If ever, guys, we roll this over and even value names take a little bit of a hit, no problem at all. What are we looking for, guys? Anything above 38,200, just going to be looking for a weekly higher low for continuation of the uptrend. This could be a very nice, guys, right? Break out of the all-time high range of consolidation, breakout, retest this lower level right here, and then run on to further all-time highs. That could be a very nice trade opportunity. That's pretty much everything for our indexes. Now let's move into some big tech names, shall we? So we're going to go through these quickly just because a lot of them are predicated on earnings moves. Apple price action. Obviously, you guys know Apple has earnings on the Thursday session. We will cover the expected move on the day before. That being said, guys, Apple is right now in a daily downtrend, trying their best to protect this area of support right here, which is your 219 down to about 215 location. So tomorrow, if Apple opens negative, you can see they're down in the after hours. If we break 214.52, unfortunately, daily downtrend simply continues. And at that point, weekly consolidation continues as well. Be very careful, guys. If we get too close to 207, if we lose this location after earnings, your weekly uptrend, unfortunately, will be lost. And then it will be up to Apple to prove to us, can they reset this into a weekly uptrend? Or maybe do they need to have extended consolidation and bring us back into the 200, 205 location, setting up for a little bit of monthly consolidation in the month of August, breakout of the all-time highs, retest the all-time highs, and maybe run. That is the trade that I will be patiently waiting for. I like Apple better in the 205 down to 200 location. That is where I'm going to be patiently waiting to play the stock. And for that reason, I'm not really touching this one until they have their earnings come out on the Thursday session. Moving on further into AMD, of course, they had their earnings today, up 7% in the after hours. So now, guys, we have a very decent bounce underway. Take a look at this. Daily downtrend. Last leg of the daily downtrend with the lower lows was right here, culminating in today. And now we will have a daily engulfing move. So this will be the chance, guys. The bulls will create enough space off the lows to maybe be able to reset into a daily uptrend. There is a little bit of a swing trade coming here right now, guys. The swing trade is as follows. We have a bounce at 148, right? So let's say that for which reason they continue consolidation. Let's say that earnings for semiconductors tomorrow are negative and pulls AMD back into this location right here, talking about maybe the Let's zoom in a little bit, talking about this location right here, right? 144, 143. If we pull back into this location, hourly downtrend, there could be a trade opportunity for the larger time frame daily trend reversal, right? So the entry would be here. The stop loss would be below the low. So the entry would be around 143, 142. We're risking $10, but what are we going for, guys? We are going for the daily uptrend shift, moving into the next area of resistance, about closer to the 154, right? So that could be a nice trade opportunity on AMD, if I do say so myself. We will see what happens. Obviously on the weekly, guys, we are still crushed, but nice to see our support level got respected quite decently. That was 142 down to about 131. We will see when they can get, if they can get, and when they can get that daily bounce underway. How high does the daily trend take us into this weekly consolidation? Keep an eye on the size of the move, guys. If we do get a nice daily uptrend on AMD over the foreseeable future, then we need to measure the size of the bounce on the weekly. This is a big weekly move down, guys. Need to see a very healthy move. Need to at least move all the way back up to 167 to give the bulls the best chance at resetting the weekly uptrend. So AMD has a lot of work in front of them. Hopefully for them, this earnings release will be the start of that daily uptrend and the start of a little bit of weekly momentum higher as well. Keep an eye though, big resistance above us, 155 to 161. Moving on to Amazon right now, give me a quick second. So Amazon was down 0.81% on the day today and down a little bit more in the after hours, 0.86% as well. So I'll remind you what we're looking for on Amazon, guys. Daily downtrend, nice bounce underway, but they do have earnings, guys, coming up on the Thursday session. So even by tomorrow or thereafter, if they're able to reset into a daily uptrend, it will not matter, guys. Amazon is going to move about 7% up or down, which could take us either back to the all-time highs or could really bring us down below into our green box of support. So the short-term price action, guys, I can't put too much influence on it just because of how they have earnings on the Thursday session, right? That being said, the bears are in short-term control of the daily downtrend and weekly is in consolidation mode as well. You can see very gorgeous weekly uptrend right here. We are protecting the weekly higher lows down here at 174.66, right? If ever we lose this over the course of the week with earnings, just rely on this big zone of support, guys. 175 down to about 165 should be the location where the bulls put up a heck of a fight for this stock, right? Why? Because at that point, the stock will be down 12 to 18%. As I've been showing all week. How far was the drop in April? It was about 12%. How far was the one last fall? About 17%. And Amazon, when you go back in time in the context of bull markets, usually has always been a good proposition to buy this stock anywhere when it's down over 12 to 15%. That is why I do believe this is a good area to start buying, just because of historical averages from drops from the highs, and also because this is a huge prior resistance area for two whole years almost, right? 2020 and 2021. Now we're above that location, guys. So this area is going to be excessively difficult for the bears to get through in one clean shot. And for that reason, guys, if we do come down here after earnings in the low 170s, even mid 160s, I am going to be a very firm buyer of Amazon shares down there. I personally think they'll have a very good quarter, but you guys have seen how earnings have been received by the market so far. And almost every company that's reporting good earnings, right? ASML, TSMC, Netflix, Google, and even Microsoft today has been largely priced to the downside. So just keep that in mind when looking at future earnings this week. Moving into Google right now, Google was actually up a little bit on the day, but retracing a little bit of their gains in the after hours right now, right? So because of the Microsoft decline, of course. Now, daily downtrend is still on motion on Google. We do have a little bit of a daily bounce underway, which was a recapture, ever so slight recapture of the hourly uptrend. But you see how weak the bulls are down here, guys? That, in my humble opinion, is just maybe going to be a bear flag and potentially roll over as the week advances if tech earnings and Jerome Powell are not well received. That being said, this whole area above us, 179 to 138, is acting as resistance. As a matter of fact, I should pretty much make this one red by now. I apologize. I haven't been keeping up with the colors on my chart. So let's just put this to red real quick. I know you guys don't like seeing red, but it's just the fact of the matter. Overhead resistance, the moving averages 2, may just be looking for a lower high and then revisit the lows of or lower. Now, moving on to the weekly, guys. Big weekly move to the downside. We have officially lost the weekly uptrend on Google. That was a loss right here of 171. So even though they have lost the weekly uptrend, guys, they can eventually recapture it. Something like this, right? Google had a nice weekly uptrend going. They lost it after earnings, and it took them a while to get this back. We see this on Meta a lot. So I wouldn't be too worried about Google at all. And usually, if we do come down a little bit lower here, guys, targeting maybe the mid 160s areas. Why? Because that is where the gap fill from the prior earnings is, and it's where more support comes in line, right around that 165, 160 region. That might be the extent of the fall on Google. That would put them down pretty much 16 to about 18% total top to bottom. Right now, they're sitting about down about 10, right? If we go down all the way 15, 17%, take a look at your previous drops. This one was the month of March, right? So we go into March and April down about 15%. Good buying opportunity. Take a look at this one, 14% as well. This was last fall, right? So that being said, it's usually always been a good proposition in the context of an overall bull market, buying Google when it's down 15 to 18%. So I maintain the same thing that I've been saying about big tech for the past week at least. These levels, good for a little bit of a nibble, but down here, that is good enough for a decent size buy. Moving on to Meta right now. Meta down 0.54% and a little bit more in the after hours because of Microsoft earnings, of course. So Meta, no stranger to the daily downtrend once again. We will see Meta earnings tomorrow. So deriving price action, guys, is going to be absolutely impossible. Let's take a look at the expected move on Meta right now because they did drop today. So let's see the expected move. Expected move on Meta earnings is about 10%. Oof, that's going to be a big one, guys. 10% up or down. So 10% up or down, if they're good, it can bring us right back close to the all-time highs at about 516, at which point, similar to AMD, the daily uptrend will be back in motion, and then they have a lot of space to just continue this down the line, right? But a negative 10%, guys, would really crush this stock a lot more, bringing them down to approximately, let's call it about 420, 410 regions, which would not be good for the short-term price action of the stock. But I do maintain it would be a great long-term level for buying, right? Obviously, at that point, Meta has already lost the weekly uptrend into weekly consolidation mode and into monthly consolidation as well. But this location right here, guys, 420 down to about 400, even 390, such a beautiful location of price action in my humble opinion. It is exactly where we bottomed out after last earnings, and it is the start of the gap fill area of 2 quarters ago. So if ever Meta comes extremely strong down in this location tomorrow and tries to fill this gap as a whole, I think that will be a gorgeous opportunity to buy Meta myself. The fundamentals of the business are doing amazing. In my opinion, they're going to have a very good quarter, but you guys have seen what's happened, right? Anything other than outstanding guidance is not being very favored right now. If they do come all the way down there, guys, that would be a decline on Meta of anywhere between 21 26%. Usually it's always been a good opportunity in a bull market. Look, 20% decline, very nice buying opportunity. If we go back in time, guys, right, last fall as well was down about 15%. Great buying opportunity in the context of overall bull markets. Meta, 15 to 20% declines have always usually been well received. We're not going to talk about this because this was complete asset destruction in 2022 for all markets. But if you go back in the past history of Meta, usually buying it in overall bullish market conditions has been a fairly good endeavor. And so I do maintain Meta at these levels right here, decent for a little bit of a nibble. But if we come all the way down here, guys, pretty much 435 and below is a very healthy buying opportunity in my opinion. PEG ratio of 1.23, and that was at 500. If I were to do this analysis again at 456, it would be even better. As a matter of fact, we have all the numbers pretty much on the screen right now, so we can just do it together, right? 456 divided by your 2024 EPS, 22.58 divided by your EPS growth rate, 20%. That's about a 1.13 PEG. So cheap, right? A lot cheaper than Starbucks. Moving into Microsoft right now. So moving into Microsoft, their technical analysis, obviously after their earnings, will remain to be seen in terms of tomorrow's price action. Nice to see them recover almost half of the drop that they had. That being said, we are attacking our lower level of support, which is exactly where we said the stock could drop into today with the expected move. So obviously, guys, daily downtrend on Microsoft will be accentuated with tomorrow's drop, and any bounce just going to be looking for a lower high, and then it depends on the size of the bounce. You guys know the rules. If we get a very nice bounce, 61% or better, sets up the bulls to be able to reset this into a daily uptrend. But any weak bounce could just be a rollover or revisit of these lows down here. Big support remains maintained at 405 down to about $390. Big prior support on Microsoft. Unfortunately, at this point, because we are now below 405, we'll see how the week closes. We are in jeopardy of losing the weekly uptrend, but Microsoft has done this in the past as well. You can see it right here, weekly uptrend, loss of the weekly uptrend by cutting these lows right here, and then it takes them a while to recapture it, right? So that could just be case in point into what Microsoft's going to do, but a very good position to be buying Microsoft right now. I am guaranteeing you guys, I will buy some shares of Microsoft tomorrow. And if they drop more, I will buy a little bit more shares. Microsoft is now down 14% from the all-time highs. In the context of bull markets, this has usually always been a very healthy proposition to buy Microsoft when they're anywhere down between 11 and 15%. So I will continue to add in this position. Moving on to Netflix right now. So Netflix down about 0.7% as well. So Netflix, unfortunately, continuing its daily downtrend decline right now, and we are still trying to battle in this area of support, 632 down to about 603 in this location right here. So we'll keep a close eye. Netflix will obviously be affected by the rest of big tech, even though they're not exactly in the same industry, guys. As a whole, Amazon and Apple do have obviously streaming services as well. So any declines in Amazon or Apple can be maybe a carried trade for some Netflix declines, even though their subscriber count and their earnings were very, very good. You guys know how this works. Everything just tumbles down at the same time, right? So you're going to be keeping a close eye on this area. If ever we lose this area throughout the week, well, then unfortunately this box would now become resistance, looking for a lower high, and maybe start even delving into the lower lows, talking about 571 to 550. This would be my preferred area to be buying Netflix in. Unfortunately, we have now lost a weekly uptrend as well. So if we do get some continued weekly consolidation and some continued monthly consolidation, just understand who's in control here. Monthly uptrend, looking for a monthly higher low for continuation of the trend, which is why I feel that 575, 550 is a super, super solid area to maybe be adding a little bit of shares of Netflix. Moving on to NVIDIA right now. NVIDIA down 7%, guys. No news whatsoever, right? Just overall tech weakness on the day and increased volatility because of earnings this week. So daily downtrend simply continues on NVIDIA. That's what we were on the watch for, right? Daily downtrend into a big area of support. This is where I'm getting interested in buying NVIDIA. As a matter of fact, I did write some short puts in this location today at $94. NVIDIA now getting very close to oversold conditions, right? The last time they did this in April, usually a good condition to start buying the stock a little bit. If we get any more oversold than this, we will come down perfectly into my buy zone for NVIDIA. So just be mindful of that. NVIDIA will be affected by these three earnings tomorrow: ARM, Qualcomm, and Lam Research, right? So keep that in mind, guys. Weekly, looking at a weekly downtrend as well. Very, very solid momentum by the bears right now. This is going to be a make or break area for NVIDIA, but I do believe the bulls will be able to put up a fight, especially when we get lower, 100 down to about $95. That's where the real big support starts kicking in for the bulls. And we may just be looking to fill a few of these gaps, right? A few of these gaps that were left after earnings, may just be looking to fill those and maybe start a recovery. But we'll be on the watch out for that, guys. If you want to know when this one is bottom, just very, very easy. Keep an eye on the hourly trend shift. So far with the after hours move right now, we do have an hourly uptrend shift, 5% to the upside, gorgeous recovery by NVIDIA. We will see how much that can translate into a daily bounce. How close can we get to 116? And if we can get the space required to reset into a daily uptrend, that is going to be the next step for the bulls. So the bulls have a lot of work in front of them to reverse this daily trend and also to start reversing this weekly into an uptrend as well. But happy to see that AMD really helped the start of that. Moving into Tesla right now. So Tesla was down 4% on the day. Consolidation, no real news at all, just overall tech weakness, right? We were always expecting this, expecting the lower high in confluence with our previous support, which is now resistance, overhead moving averages 2. So not surprised that Tesla set the lower high right here and maybe looking to revisit the lows. How was the size of the bounce on Tesla? Well, I'm glad you asked, guys. Not even 50%. So we cannot say that the bulls are guaranteed a chance at a daily uptrend shift. They have a chance, but it's not a very good chance. Not as good as if it got as high as 240 to 250 on this bounce, right? This would have been a great chance at a daily trend recapture, but as of now, momentum still does favor the bears. So we will be on the short-term watch, guys, for a break of the lows right here, continuation of the daily downtrend, and continuation of the weekly consolidation move, which could maybe take us as low as 205. 205 down to about 180 is where I really start getting interested in Tesla as a whole. Moving averages are there, and it starts to be the end of our big box of support, which is pretty much, I mean, we can extend this down a little bit lower, down to about maybe the 195 location right there, if we really want to encapsulate all of the candle lows and so forth and so on, right? But you guys understand, big resistance, big support for the stock, resistance as well, support, and then turn resistance once again down here. So that's why I say this lower area right here, 205 down to about 195. If we do come down close to there, I'll be probably playing some short puts, maybe in the 185, 190 range. I do believe that is where the bulls will be putting up a lot of support. Moving into Palantir now. So Palantir, another decline on the day, 2.62%. It's not Palantir's fault, guys. It's really the rest of big tech just coming down. So they have earnings next Monday, as a matter of fact. And after 9-10 weeks of beautiful rally, it was just time for some weekly consolidation. So unfortunately, Palantir looking maybe to set up for the daily downtrend. We will be on the watch for a break of Thursday's low. Yeah. If we get a break of that, daily downtrend simply continues at that point, and we'll just be looking for further weekly consolidation, anything above 20.3, just looking for a weekly higher low for continuation of the weekly uptrend. Now, as we get closer and closer into this support zone right here, 26 down to 25, if we come lower into the 25 location, I'll be looking to maybe play some short puts. $24 range could look good. I looked at some of the options today. They weren't paying that much premium at the 24.5 or lower. The one that I really want, guys, I want 24 short puts or 23. Get me closer to this bottom range of support. That's where I think that Palantir, that's where I think it'd be a better value proposition for Palantir. Obviously, we wouldn't want to see them take back all of that move, but if we come down 25, 24s, we may see some premium open up in the 23s, and I do believe that's a little bit of a safer play, especially in light of all the tech weakness right now. So that's pretty much everything we had to cover, guys, in terms of earnings, technical analysis. So hopefully all of that makes sense, guys. Now let's take a very brief look at my portfolio for some of the positions that I opened and what I plan to do with the rest of big tech earnings. All right, guys, so taking a look at the portfolio right now, just because we did a very large portfolio recap today, I'm going to go through these very, very quickly. So we had a few earnings plays leading into today. We had SoFi, we had PayPal, we had Procter & Gamble, and we had Symbotic yesterday after the close. So how did those work out? Well, Symbotic, we took a very, very tiny loss. As a matter of fact, it might have just been break even. So take a look right here. We had the $26 puts that we sold for about 20 cents. And then a bit later, guys, we also wrote the $25 puts for 22 cents. Now today, we did fairly good on them. We bought one back for 15 and we bought one back for 25. So I would say we only lost maybe a couple of dollars, even though Symbotic had a tremendously bad earnings rollout, right? We were able to close these early on in the morning session. We actually sold this pump right here. Very happy we were able to get out of those options unscathed, but pretty much just a non-effect in terms of trading, right? No profits, no real losses, just really, really safe. Now, the second one was Procter & Gamble. Procter & Gamble, as a matter of fact, we took a very tiny loss because Procter & Gamble came down roughly more than the expected move, right? So we had the 157.5 puts. At a first glance, they did appear good. But on the morning, guys, the morning session didn't start off too well at all. You can see they really struggled for a large majority of the morning. So tradition to my fashion, guys, I always close these earnings trades usually within the first hour of trading. I let them settle out a bit, and then I pretty much close and try to get the best exit as possible. That being said, probably if I would have held into the end of the day, we actually might have been able to be profitable, but that's not the point. The point is to just close them if it doesn't work out and use the capital for different trades. We're not trying to stay in these all week. If I would have kept these all week, we probably would have made some decent profits, but still. So let's have a look here, guys. In terms of your Procter & Gamble. So Procter & Gamble earnings, we wrote them for about 11 cents, not much premium at all. And we actually closed them at a slight loss this morning. You can see right here for about 69 cents. So we pretty much lost there, let's just call it about $60 for all intents and purposes. Not a large loss, but a large, just the same. So I figured I should show you guys just in the purpose of full transparency, right? The SoFi earnings trade was very, very good, as a matter of fact. We wrote these $6 puts for 11 cents, so $33 in premium, and we wrote these $6.5 puts for $66. So all in all, about $100 in premium. Since SoFi did so well this morning, we were able to close them for almost nothing. You can see I closed these almost worthless. So let's say for all intents and purposes, we realized about 95% profit on those SoFi earnings plays. So those were very good. Now, PayPal as well was another big win for us. So in terms of PayPal, what happened today is we had a couple different plays leading into the earnings. We had the $50 short puts, which we got about $15 for them. Well, happy to say, guys, we were able to close those $50 puts for a penny. So 99% profit realized there once again, another earnings success. And we also had some PayPal calls leading into earnings, and they performed very well too. So PayPal, we had these 65 calls for October, just looking for an earnings beat, which is exactly what we got. We paid $209 for them, and we were able to close those at a nice little profit here of about $390. So not quite a 2x, but very, very close. If I would have kept them more throughout the day, I probably would have ended a little bit higher, but we actually got some very, very good pricing on them early on in the morning, guys. I pretty much sold the high of the initial move right here. So it was looking very, very, very good. This is why I took profit 8%, in one single day. This was an earnings play, so I figured I should close it right away. So all in all, across all earnings plays, guys, yesterday, we were net positive. So happy to say, guys, even though we did have one that was pretty much flat in Symbotic and one tiny loss on Procter & Gamble, the rest of the wins largely made up for it. Now, in terms of earnings plays that I had for this today after the close and the ones I'm looking for tomorrow, We had some AMD 110 short puts. There was a lot of premium on these leading into the close just because of how bad the day it was, right? 110 puts. The stock was at 136, twice the expected move, guys. I would have loved being assigned shares down here, but unfortunately we didn't. This one should end completely worthless because they beat, so we should be collecting $21 right there. In terms of other earnings plays, none of the rest of the, if you see a blue dot right here, it means it's a new position. Everything else we pretty much covered yesterday, so no changes on any of the other positions. The only one that I wanted to show you guys is we did open an NVIDIA $94 put today because they had such a bad day, and we got 53 cents for them. So more than 0.5% and exactly in my range of support. We will see how those goes. I would be pretty sure that we're going to be able to close these probably for a significant profit tomorrow. So we'll see how those goes, but nice little trade that I did there intra-week. And then we took some Starbucks just because of my luck on Starbucks recently, right? Obviously, this always happens, guys. The past 2 times on StarBUX earnings, we were slightly bullish, expecting less than expected of a drop, and it dropped way more than expected. So I figured this time around, just because we knew that their earnings were going to be bad, right? Which they were terrible earnings. I went a little bit bearish, but I didn't go too heavy at all, right? So we had one $65 put for Starbucks, which was slightly above the expected move. Expected move was about 8%. This was more towards 11% drop. We only paid $29 for these put options, guys. So yes, these will be worthless tomorrow, but not a very big loss, right? Our profits for the day largely cover this one. And then we also went with, there's another one somewhere down here, somewhere. I'm not too sure if it was, I'm not too sure where it is right now, but we went with these Starbucks. Yeah, here they are. Starbucks bear put spreads. So this is pretty much like a call debit spread, but it's a put debit spread. We went with 2 contracts, which is basically the 72s versus the 70s for the end of August. We're basically trying for the stock to end under 70 by the end of the month of August. Obviously with the earnings rally right now, these will probably take a hit. Probably going to have to close them tomorrow. But as a whole, we only paid 2 times $63, so about $120. So all in all, across Starbucks, we only paid $150 to make a bearish earnings play. Not that much. These puts tomorrow will probably be worthless. Maybe we can salvage a couple pennies on them, and these will probably be at least 50% off. We'll be able to salvage a bit because there is about a month of time left, which is why I put a month of time on those. So it won't be a total loss, but we will probably lose, maybe a good, maybe $80, $90, $100 on this one, but still largely offset by the profits that we're going to make today and into tomorrow's session. We did also write some SoFi $7 puts for the remainder of the week. SoFi pulled back after their earnings today, so I'm looking to maybe get assigned at $7. We got over 2% in premium for them. You can see they're already about half off, so we are 50% in profit right now. Looking very good. 3 contracts, right? So about, let's call it about $50 of notional value right there. And the rest of pretty much everything is the same, except for this one right here. This one I went a little bit heavy, guys, just because of what Starbucks has been saying. Chipotle as well are a bit concerned about the consumer. Everything in between, right? McDonald's, we can go down the list, right? Wingstop, I have to be bearish on this one. I absolutely have to go for this earnings play. They have earnings tomorrow. I spent roughly $1,000 on this earnings play. Usually I don't spend that much on earnings play, but this one, guys, it's ran substantially, right? The PEG ratio for this stock, the P ratio is about 130 right now. The PEG ratio is about a 5. 5 is ridiculous. And in an environment where the consumer is slowing down, this may be a prime candidate for a little bit of a downswing if ever their earnings are not perfect. I'm not saying the company is not doing well. It is doing well, guys, but look at the valuation, right? They're only making $450 million of revenue a year. The company's valued at $11 billion. Price to sales of 20. It's too much. The valuation of the company in all metrics is way, way, way blown out of proportion right now. Take a look, guys. Yes, they are expanding EPS nicely. They are expanding revenue very nicely over the next couple of years as well. But the valuation now, even with this growth, is just way too high. That's why we use the PEG ratio. I did it myself, guys. The PEG ratio, they have EPS, their PE ratio on a forward basis is about 110. Their EPS growth rate is about 20. PEG ratio, divide 110 by 20, it's over 5. That is just absolutely ridiculous. And it's in a consumer discretionary segment. So I feel that this one may just have some drop leading into it. We're monthly overbought conditions as well. We were weekly overbought, but you can see we're rolling over on the weekly trend right now. If they miss earnings tomorrow morning, or if it's underwhelming, we could have a big surprise to the downside. And that is what I'm counting on, right? Very speculative play, but I'm going with the directional bias of the market right now. So we went with 3 bear put debit spreads right there. So these are put debit spreads 350s versus 340s. We got some good, we paid decently for them, only paid about $3.52. The total profit expected, guys, is about a 2x. So I'm looking to get maybe about $700 to take profit on this one. So we're looking to close these at $7, in other words. It should be roughly a 2x if the trade moves in our favor. If not, we have these for September. So there's a lot of time left on these. Even if Wingstop has a gain tomorrow, I am tempted to hold these guys because if we see further deterioration of the consumer, it may start to affect Wingstop stock. They may be dragged down as well as the rest. They are the only food company that has not dropped too much. Everybody's dropped. McDonald's has dropped. Chipotle has dropped. Starbucks has dropped. Everybody's dropped except for these guys. So I'm waiting for them to potentially drop or under the moving averages. So everything pointing towards a drop. Now, can the company perform amazingly tomorrow and go up 20%? Absolutely, guys, but I am taking a big bet for the contrary, so we'll see how it plays out. So hopefully that makes sense for everybody, guys. In terms of the earnings that I'm playing tomorrow, same strategy for after the close. Going to be probably, maybe not Meta, because Meta to write short puts is a little bit high. In terms of that, what I did for Microsoft when everything's high right now, you can see Microsoft, what I did is I opened some 390 versus 385 bull put credit spread. So we got 52 cents in credit for about $500 worth of risk. Microsoft should close above 390 by the end of this week, so this one should be profitable. I may do the same thing on Meta, maybe looking for some put credit spreads, maybe the 410s versus the 400s, maybe for the end of the week, which is, you know, probably twice the expected move. So that's maybe how I'm going to be playing Meta. ARM, probably not going to play. Qualcomm, we'll see if I can get 2 times the expected standard deviation move for some short puts. You know, at that point, we'd probably have to be looking for Qualcomm down here at like the 140s maybe for some short puts. I'm going to be really conservative on them. And obviously, in the after hours Lam Research, their share price is way too high to be playing them anyways. And that's pretty much it, guys. I don't think I'll be playing Albemarle, Agnico Eagle, or even Riot, Blockchain, right? I'm not sure I'm going to be playing much of these other ones. I'll take a look. Maybe Western Digital, I'll be playing these very conservatively. Carvana, definitely not going to be playing at all. ARM, I just don't want to play just because their valuation is just, you know, a little bit high in my opinion. Even at 163, it was well over a 2 peg. If I can get some decent premium on ARM at $100 or maybe 105, 107, I might be doing those, but I'm not looking too forward to it, guys. ARM's a great company, but it's not one of my favorite companies just because of the valuation concerns right now. So that's pretty much everything for the Wednesday after the close session. And Thursday morning, I don't think I'll be playing any of these. So I just wanted to brief you guys on those. MasterCard, those, if they have a drop after earnings, I'll just be probably buying shares, guys. Maybe going with some bull debit spreads for October. One strike maybe out of the money, depending where they end off after earnings, right? So that's just a little bit of context of what I'm looking to play tomorrow. And then for Thursday's plays, we'll cover them tomorrow after the close, right? So hopefully you guys enjoyed today's video. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing to the channel if you're new as well. Would love to have you here. We do these every Monday to Friday after the close. Hope to see you back soon. And then lastly, if you have any questions at all, guys, earnings plays, other plays, buy the dip plays, value plays, anything you want, leave it down below in the comments and I'll be happy to answer you within the next 24 hours. Take care, guys. Happy trading tomorrow. Very volatile day. Be very careful. Jerome Powell and tech continuation. Peace.